Hello, hello. So we need to be talking about some key things. What does a Fed pivot really mean for the whole industry? And really, where is our crypto going to be if we do see a very, very big pivot from the Fed? So this is kind of what gave us, I'm doing a little bit of just a little typing up here as we go. The key thing that really kind of gave us that little bit of a push that we saw in the markets yesterday, I think it was primarily down to the fact that everyone was thinking, oh, hang about. I'm not sure if my mic was working then. Need to do a little check. I think it was just primarily because everyone was worried about, well, what is actually going to happen if the Fed do pivot? And are we going to have a massive pump in the market? So typically that is what was expected. And I'm going to show you this right here from Bloomberg. So she might not still be talking about it, but Dali, she is from the Fed. And she says that we do see more rate increases as necessary. So we'll see if she's still mentioning about this. Inflation has become more persistent than people expected. Exactly. So there was calls from the United Nations, which basically said, look, Fed, please stop raising rates. Just stop because you're pushing all the other economies pretty much down the toilet. And so this is what everybody was worried about. And so consequently, what we have done now, or what, I think what the market came to realize was that if the Fed paused, yes, we would have a great pump. And everyone tried to anticipate this. Every time the Fed pivots from rate hikes into, either standing still or reducing rates, we've had in 2003, 2018, March 2022, March 2020, I should say. So we've always had a massive return or massive turn in the markets whenever this has happened. So we're trying, I guess, to anticipate this. And I think that's why we did have that pump yesterday, but we haven't yet so far. So let me just show you what exactly it would look like for the markets if we do have this pump. So here we go. We'll pause her. Thank you very much. Firstly, mortgage applications have plummeted 14%. This is very, very good for the Fed because obviously they look at core inflation. Now, with core inflation, this includes housing, not food and not energy, but it does include housing. And so as we see less people kind of applying for houses, etc., it is a sign that basically the stock market kind of basically dropped. And so now we're looking for the housing market to also do the same as well. Mortgage rates have risen by a disgusting amount. So they've risen for 7 weeks to the highest in 16 years. Give me 1 second, guys. My dog was just trying to chew my foot off there. So we're seeing the housing market really be condensed, which is actually a good thing. It means that we're going to have lower house prices, lower rental yields as well. And so that means obviously everyone's rent will go down. CPI will begin to come down as well. So it does show us we're at the beginning of this inflection point for the markets. There is more downside, I think. But this whole talk of a pivot is going to be something that kind of pushes people forward, should we say. But obviously, we're still going to have a really strong DXY because the European benchmark halts best 3-day rally since 2020, and that's great and all. But 1 second, Caesar, have a great dog, but he loves to make noise. And so what we're seeing is obviously as European markets continue to crash, we're going to have everybody moving into the dollar because it's just the most safe for now. And everyone doesn't know exactly how long this whole global recession, if it's going to happen, is going to go on for. And so I just want to mention, as I said earlier, the pivot is the number one thing that everybody is looking at. Okay. But quantitative tightening is something that's really gone under the radar for, I think, everybody. And basically, quantitative tightening is, how everyone said, the Fed has $9 trillion in assets. Well, this is the process of getting rid of those $9 trillion. So how are they doing that? They stop buying bonds, essentially. And because there's less pressure of them buying bonds and they even begin to sell them, there's a lot of bonds on the market. So the price goes down, which is why the yield is kind of beginning to come up. If you look at the 10-year treasury, the yield is coming up, which is not great, but hopefully everyone begins buying them again because the yield is so attractive. And that's one step closer to us getting to, right, okay, we bought bonds, now we need to build our portfolio without just bonds. And then we see everyone move back into stocks. So that's what I'm thinking will happen probably in the early stage of 2023. But we do have some statements here. A market riot won't stop until the Fed reverses course, I should say. The Fed reverses course on its aggressive tightening strategy because they're selling 90 billion, no, 95? Yeah, no, $95 billion worth of mortgage-backed securities and treasuries every single month. Guys, it's absolutely insane. And so, yeah, everyone's looking for the Fed to stop, their aggressive, basically dumping onto the market. Now, one thing I want to add on here is US companies added 208,000 jobs. Now, one thing, I should say, let me bring this up. Yeah, St. Louis. Have a look at this here. So I've mentioned this before in my previous videos, as you guys will have known. The Fed have kind of flip-flopped quite a lot. Basically, what they said is, hey, we want inflation to come down to a certain level. And then they said, okay, we want inflation to come down to a certain level, and we want unemployment to be at 3.7% by the end of this year. And then they changed and they said, actually, inflation could be a little bit higher. And then they said, actually, we want unemployment. They're now at the point where they've changed the forecast for unemployment, and that's the only thing they're going to be focusing on. That's the primary factor. And they're hoping that through doing this, inflation will just kind of check itself anyway. Which, you can say it's true or it's not, but anyway. We're looking now at a 3.8% by the end of this year, which is why the markets have dropped today. We can have a look at this bit. Investing.com. Let's go into this. And I don't necessarily want to look at these rates, but I do want to look at this. So as you see, S&P is down, NASDAQ is down. We can go to coin market cap just to look at all of the coins as opposed to just, trading view where we see one. Everything is down. And it's because we have had the ADP Jobs Report. So that came out today. ADP Jobs Report shows 208,000 jobs added in September. So looking at this shows that there still has been a strong demand for workers. It is less, guys. It's less than previous months, not less than last month, unfortunately. But as you see here, there is a very strong downward trend. So we're moving in the right direction. This is provided by Bloomberg. We are moving in the right direction in terms of jobs added, but we're not, we need multiple reports. And like I said, yesterday, I think that because we had a bit of good news from the Fed, a bit of good news from overall job markets, that it was like, hey, everything's kind of going okay. You had a lot of narrative data from the likes of CEOs and headlines like from Wall Street Journal, for example, New York Times, who were saying that, we are getting to a stage now where it's not as easy to find people to work for your company. And so that means that less people are just going to say, hey, screw your company, I'm going to go join somewhere and I'm going to get a higher wage. Because when we have that, that's a wage price spiral. And then obviously, if you want to attract talent, you have to up your wages. And if you up your wages, you have to up your prices. And that's good in a closed system because people can get higher wages and then they can afford to buy your products. But what about, it gets to a boiling point where that just doesn't work. Because you get to a point, you can't just keep charging everyone more and more and more. People just won't buy from you. But if you're still hiring at higher wages, you're squeezing your margins as a business. And that's one of the worst things that can happen. I do think we will see a bit of that effect coming into play over the next month as it's earnings season. So I do think that might have some kind of effect and keep us at these lower levels for the next few months. So I wanted to bring this up. We're trending down on the jobs reports, but the Fed said they want to see multiple jobs reports giving us an indication. And so obviously this is why someone like Mary Daly, she's been saying that inflation is still problematic. They're looking at jobs and it hasn't quite worked out. And so, yeah, just bringing us into the crypto world. we're seeing this on a slightly shorter time frame, repeats key bear market move as 19K becomes key Bitcoin price zone. And the thing is, look, guys, 20K is a very psychological level. It's hard to break above. I know we did, and I called it a fake out yesterday. It seems I was right to have done so. But I do just think we have to look at the much wider picture, and that is that the Fed are not happy. They still need to do an awful lot of work. And, when we do have great bits of news from crypto, there always comes a bit of bad news behind it. So I'm just looking at this here. So this headline, and I don't like to look at only headlines. As you know, I like to look at the whole fundamental picture and see what's going on. But just looking at the headlines, Bitcoin still has 14K target, warns a trader due to DXY parabola break. And that is pretty much it, So obviously this is Bitcoin. We all know and love Bitcoin. And so this is the indication. Where has he mentioned about the old DXY? Okay, so yeah, if this area fails, we could push deeper into the box given the BTC SPX more time to rally. Fellow trader Main explained in an accompanying thread, also mentioned the SP 500. If this area fails, we could see a break in the dollar's parabolic ascent and perhaps a much longer sustained rally. So DXY circled 10.6 around about this level here at the time of writing, have narrowly preserved 110 as support, still making its lowest levels since 21st of September. So as you see, obviously we are dropping to the downside. I know AJ has gone through this. We are seeing more downward pressure on the DXY, but we're still making those higher highs, higher lows, I should say. Well, both. Yeah, both. So higher low, then we go higher, then we go higher high, higher low, and then higher high, higher low. So I think we're going to see much more pressure because we aren't at these levels of unemployment here at 3.8, for example, and we're going to have more of this data coming out soon. But it's giving a little bit of, negative pressure, should we say, because there's so many jobs being added, and the Fed have flip-flopped so much that they've now committed hey, it's going to be unemployment. That's what's going to drive our inflation to the downside. But that just hasn't happened. And unfortunately, now we're seeing the price being paid. But anyway, guys, that is everything from me. I just wanted to give you this kind of short little overview as to what I think is going to be the main driver over the next couple of weeks and months. And so it's going to be the Fed's talk about a pivot. And they're not currently looking at pivoting anytime soon. Still on the cards, as economists reckon, 67% of people saying that we have a 75 basis point hike in November. That, my friends, is not a pivot at all. Really not a pivot. And this might be slightly more updated. Let me see. I'll just refresh this, see if there's any difference. No. So yeah, we're still looking at a 75 basis point, and then this is going to be a 50 basis point, I imagine. Yes, this is going to be a 50 basis point. So no chance of a pivot in the economists. And I think because we're getting more data like these jobs report, this is what the Fed care about, and the Fed are not going to stop, as we have seen from numerous people in the markets. Anyway, guys, thank you very much. I will see you tomorrow. Drop a comment if you want me to discuss anything in particular, but also just drop a like if you did enjoy the video, and I will see you later. Take care.